watching Big Brain Energy. Okay, so you know what taxes are, but you need to know how to draw on a graph for your economics class. Well, in this video, we're going to teach you exactly how to do that. In this video, we will cover exactly what an excise tax is, how you draw the tax graph, how elasticity affects tax, and then how to word your answers for the NCEA external. And lastly, we'll do some practice questions. Check out our playlist for everything you need to know for the NCEA Level 3 external, demonstrate understanding of the efficiency of market equilibrium. Let's get into it. There are different types of taxes, for example, GST tax, or income tax that you pay on your wages, or business tax. And in this external, we focus only on excise tax. Excise tax is a special indirect tax placed on specific goods or services. Often it's used to discourage consumption. Basically, it's a tax above GST, so it's put on top of whatever you're already paying. And it's only on specific goods or services to make them more expensive, to therefore discourage people from buying it. How this actually works is that when the government decides that they will place an excise tax on something, for example, maybe on petrol, it is now the responsibility of the petrol station to ensure that the correct amount of tax is paid. In order to do this, they will probably increase the price of petrol to cover the amount that they need to pay. When the petrol company makes the consumers pay tax, this is called passing on the burden of the tax to the consumers. Basically, the government tells the petrol company, you need to make sure that this tax is paid for every litre of petrol that you sell. And then it's up to the petrol company to decide how they want to cover the money for that. Some common examples of things that have excise tax are cigarettes, alcohol, petrol, gambling, and even heavy vehicles. Alright, let's have a look at how to draw the tax graph. We start with a regular demand and supply graph. So we have price on the y-axis, which is the price of the thing being sold, and the quantity on the x-axis, which is the quantity of the thing being sold. And we can begin by drawing in the regular equilibrium, PE and QE. To illustrate a tax on the items, we draw in this tax curve, which is parallel to the supply curve on its left. We label this tax. Sometimes you'll see it labelled as maybe something like S plus tax or something else along these lines. We can then draw on a new equilibrium where the tax curve crosses over the demand curve. We label this QT for the quantity sold under the tax and PC for the price that the consumers pay under the tax. This price that the consumers pay is higher than what they originally paid because the tax makes the thing more expensive for them. Now this is the tricky part of the graph. Here we need to draw a dotted line going out to the price axis where the new quantity QT crosses over the original supply curve. We label this PP for the price that the producers receive. So you can see that the price the producers receive is lower than the original price PE. This is because the producers have to pay their part of the tax as well. So therefore they're getting less money than they would have originally. For this external, you'll need to know 1. How to draw the tax graph, and 2. How to shade and label the consumer surplus, producer surplus, tax revenue, and deadweight loss. You'll need to know how to do this for all of the graphs that you cover in this external. For the tax graph, this is the new consumer surplus. It is the difference between the price that the consumers are willing to pay, which is the demand curve, and the price that consumers actually pay under the tax, which is PC. This orange triangle is the producer surplus. It is the difference between the price that the producers are willing to sell for, which is the supply curve, and the price that they actually receive, which is PP. This square here represents the tax revenue. It is the distance between PC and PP, which is the value of the tax being sold, and it goes all the way out to the quantity being sold, QT. So whatever this value is all the money that gets paid to the government. This triangle here represents a deadweight loss. Deadweight loss is potential value that is not gained by anyone. Basically, this area used to be part of the consumer and producer surpluses before the tax, but now it's not part of those surpluses. So it is a potential that could have been part of a surplus, but it is not. So it is deadweight loss. So that's a basic tax graph. Let's look now at how to draw the tax graph depending on different elasticities of demand. We have a video on elasticity which you can check out, link in the description if you are unfamiliar with this topic. Inelastic demand means that a change in price will result in a proportionately smaller change in quantity demanded, and the curve is steeper. Elastic demand means that a change in price will result in a proportionately larger change in quantity demanded, and the curve is flatter. So let's draw in an inelastic demand curve first, and take a look at how that affects the tax graph. So we get the regular tax curve and the new equilibrium, so QT, PC, and PP. Just by nature of the slope of the demand curve, it actually results in a large increase in price for consumers, PE to PC, but also a smaller decrease in the price that producers receive, PE to PP. This means that the consumers face more of a burden of the tax than the producers do. Let's have a look now at an elastic demand curve, which is the flattered demand curve. Naturally, it results in a smaller increase in price for consumers, PE to PC, and a larger decrease in price for producers, PE to PP. The box that is the tax revenue can be split up into the portion of the tax that the consumers pay and the portion of the tax that the producers pay. The portion of the tax that consumers pay for inelastic demand is larger than the portion that they pay under elastic demand. This is because the price change is larger for them with inelastic demand than it is for elastic. The opposite is true for producers. The burden of the tax that they have to pay under inelastic demand is less than what they would have wanted to pay under elastic demand. So we can see that depending on elasticity, it tells us who pays the burden of the tax. Why is this? Well, let's look at things that have inelastic demand, things that when the price changes, consumers are going to keep buying it anyway. This is necessities like petrols or groceries or rent. Basically, if there was a tax on these things resulting in a higher price, consumers are going to pay this tax anyway. So producers take advantage of this by saying, okay, let's just make the consumers pay most of the tax because they're going to buy it regardless of a higher price. Whereas for elastic demand, the consumers aren't always going to buy it with a higher price. It's things that aren't essential, like movie tickets or eating out. So the producers know that if they were to increase the price a lot, consumers just wouldn't pay for it. So it's easier to just pay most of the tax themselves. In this exam, it's quite predictable the types of questions they may ask you. They tend to ask you for each of the key topics to draw the graph, to shade and label the producer surplus, consumer surplus, deadweight loss and effect on the government, and then also to explain the effect on each of those things. Let's go through a model answer for each of these situations when a tax is placed on something. Starting with consumers. When a tax is placed on something, consumers are worse off because they need to pay a higher price, because the price increases for them from PE to PC. Hence, they decrease the quantity that they consume, so quantity decreases from QE to QT. The difference between what consumers are willing to pay and actually pay decreases, and there are less units from which to gain a surplus. So we are saying that consumer surplus decreases when we say that the difference between what consumers are willing to pay and actually pay decreases. This is just the definition of consumer surplus. When we say that there are less units from which to gain a surplus, we mean that they are just buying less. So basically this sentence here is saying consumer surplus decreases and they buy less. To get excellence in this exam, this is a wording that they like you to use. Let's look now at producers. Producers, when there is a tax, are worse off because they receive a lower price. So price for them decreases from PE to PP and they sell less. So quantity decreases from QE to QT. The difference between what producers are willing to receive and actually receive decreases. So that was the definition of a producer surplus. And there are less units from which to gain a surplus. This means that they are selling less. Hence, producer surplus decreases. I'll note here that in the exam they might ask you either about the effect on consumers or consumer surplus, or producers or producer surplus. The answer for both is the same, whether they're talking specifically about the surplus or just the consumer or producer in general. Let's look now at the impact of a tax on allocative efficiency. Allocative efficiency means how well is the market operating? Are the total surpluses maximised, or are there people benefiting not as much as they could be? And is there deadweight loss? If there is deadweight loss, then a market is not allocatively efficient. In this case, before the tax, the market is allocatively efficient because the consumer and producer surpluses are maximised and there is no deadweight loss. When the tax is added though, consumer surplus decreases and producer surplus decreases also. These decreases though are not outweighed by the government's tax revenue as indicated by the deadweight loss. So yes, the decreases in surplus are partially outweighed by their tax revenue, but the decreases in both consumer and producer surplus is more overall than the increase in tax revenue, hence why there's some deadweight loss. So therefore, when there is a tax, the market is not allocatively efficient. Total surpluses are not maximised and there is a net welfare loss. These last few things are what they want you to write in the exam. Total surpluses are not maximised, so that means that the producer and consumer surpluses are not as big as they could be, and there is a net welfare loss, which means that there is deadweight loss. Note also that when we say allocative efficiency in the exam, they might just say efficiency, and that means the same thing. The last situation they'll ask you about is the government. The government under a tax is better off because they receive the tax revenue, and this can be used to fund projects. For example, they could spend more on education or infrastructure or healthcare. Alright, let's now do some practice questions. Feel free to pause the video if you need more time. Firstly, what is an excise tax? Excise taxes are a special and direct tax placed on specific goods or services used often to discourage consumption. Who has the responsibility to pay an excise tax? The answer is the producers have the responsibility to make sure that the tax is paid. Illustrate the effect of a tax placed on this market. Here is the answer. We draw in the tax curve, which is parallel to the supply curve and on its left, and then we draw in QT, PC, and PP. Now, shade and label the producer surplus, consumer surplus, and deadweight loss. Here's the answer. Consumer surplus is always at the top, and producer surplus is always at the bottom, and then deadweight loss is this grey triangle. What does it mean if something has inelastic demand? Inelastic demand means that a change in price will result in a proportionately smaller change in quantity demanded, and the curve is steeper. Which of these items is most likely to have inelastic demand? Petrol, a McDonald's burger, or a Netflix subscription? The answer is petrol. It is something that people buy a lot of, even when the price goes up. What does it mean if something has elastic demand? Elastic demand means that a change in price will result in a proportionately larger change in quantity demanded, and the curve is flatter. Which of these items is most likely to have elastic demand? Cigarettes, gambling, or plane tickets? The answer is plane tickets. It is something that when the price increases, people will buy quite a bit less of. Illustrate the effect of a tax placed on a good with inelastic demand and shade and label the tax to be paid by producers and the consumers. Here is the answer. So we have an inelastic demand curve, which is steeper, resulting in a larger increase in price for consumers. So therefore, the portion of tax that the consumers pay is quite big, and there is a small decrease in price received for producers. So therefore, the portion of the tax that the producers pay is smaller than that of the consumers. Illustrate the effect of a tax placed on a good with elastic demand and shade and label the tax to be paid by the producers and the consumers. Here is the answer. So there is a flatter demand curve resulting in a smaller burden of tax that the consumers pay and a larger burden for the producers. Suppose a tax is being placed on cigarettes. Explain the impact on consumers. Consumers are worse off when there is a tax on cigarettes because they need to pay a higher price, so price increases from PE to PC. Hence, they decrease the quantity that they consume. Quantity decreases from QE to QC. So the difference between what consumers are willing to pay and actually pay decreases, and there are less units from which to gain a surplus. Hence, consumer surplus decreases. Suppose a tax has been placed on alcohol. Explain the impact on producers. Producers are worse off when there is a tax on alcohol because they receive a lower price. Price decreases from PE to PP, and they sell less. Quantity decreases from QE to QT. So the difference between what producers are willing to receive and actually receive decreases, and there are less units from which to gain a surplus. Hence, producer surplus decreases. Suppose a tax has been placed on petrol. Explain the impact on allocative efficiency. Before the tax is placed on petrol, the market is allocatively efficient because the consumer and producer surpluses are maximised and there is no deadweight loss. When the tax is added, consumer surplus decreases and so does producer surplus, and the decreases are not outweighed by the government's tax revenue, as indicated by deadweight loss. Hence, when there is a tax, the market is not allocatively efficient. Total surpluses are not maximised and there is a net welfare loss. Suppose the tax has been placed on gambling. Explain the impact on the government. The government is better off when there is a tax on gambling because they receive the tax revenue, as shaded on the graph. This can be used to fund other projects, for example, education or infrastructure or healthcare. Side note, it is interesting here that the government benefits from a tax on gambling, whereas consumers and producers are worse off in terms of monetary value. Alright, so that's everything from this video on tax. If you have any questions about the content, leave a comment below and we'll reply to you. You can also let us know in the comments what you'd like us to cover next. We will be uploading a new video shortly on subsidies, which covers everything you need to know about the subsidies for the NCEA external. We also have a full playlist on this external and other New Zealand-based economics courses, so check that out by subscribing to our channel. Alright, that's everything. See you next time for more big brain energy.